Hello and welcome to our first quarter MarketCast. It's often said that in the absence of an opposing force, an object in motion will tend to keep moving in the same direction. Well, in the first quarter, the object that kept moving in the same direction was the $50 trillion U.S. stock market. The S&P 500 index, after earning nearly 12% in the fourth quarter of last year, went on to earn another 10% in the first quarter of this year, while setting 22 new record highs. It was a great period for stock investors. The U.S. economy was stable, and growth and inflation were moving in a sustainable direction. But today, the S&P 500 index is about 25% higher than it was at Halloween of last year, which raises the question, are U.S. large cap stocks still a good buy? Or is the market about to move in a new direction? To look into these questions, let's start by checking recent performance. Overall, the markets had a fantastic first quarter, with U.S. large cap leading the way, both for the quarter and for the trailing year. And while the large cap rally was boosted by excitement over artificial intelligence companies such as NVIDIA, all the growth-sensitive asset classes had a good quarter. In fact, there was only one minor area of relative weakness, and that was U.S. bonds, which gave back some ground as progress on inflation seemed to be coming a little slower than expected. Which raises the question as to whether inflation could turn into a problem going forward. To look into that, I'll turn it over to Senior Investment Advisor David Janec.
Thank you, Ryland. In this chart, the teal line shows U.S. GDP and core inflation, which excludes volatile food and energy for each quarter going back to 2016. In the shaded area, prior to COVID, we highlight what we're calling normal or moderate levels of GDP and core inflation. And today, following the wild fluctuations of the COVID period, it looks like growth and inflation are back on a good path towards the normal range. And it's this normalization trend that has helped support the stock market. But we can also see that there's still a large gap between the current levels of inflation and the Fed's 2% target. And most forecasters don't expect that gap to close between now and the end of the year. So we think the battle against inflation has not yet been won, and that the possibility of a flare-up in inflation is still a prominent risk for both stocks and bonds. But in the first quarter, inflation was fairly well behaved, and that let investors focus more on good corporate earnings reports that came out. Here we can see that in the first quarter, 73% of S&P 500 index companies reported fourth quarter earnings that were higher than analyst estimates. Information technology companies were the leaders, with 89% beating estimates. But real estate didn't do quite as well, with only 55% of companies beating estimates. And while this was largely due to high interest rates, high vacancy rates were also a big factor, especially in the office sector. The price of office space has been falling dramatically in most major cities. And while lower office prices could in theory be considered a good thing for the economy because they can help bring inflation down, there's also a much more immediate concern, namely that these big valuation drops could threaten the stability of lenders that are exposed to the sector. In a worst case scenario, it could trigger another financial crisis. But to keep things in perspective, we should note that the office sector represents only 16% of the commercial real estate market, and that other sectors are performing much better. So we currently believe the office sector is an isolated problem, but we also think it shows how volatile individual investment returns can be, especially during a time of rising interest rates. In fact, when it comes to financial markets, it's hard to understate the importance of interest rates. In this chart, we look at the performance of the S&P 500 index during 3 monetary policy regimes. In the center panel, we can see the easy money period from 2009 to 2021. A time when the Federal Reserve was helping the economy recover from the global financial crisis. During this period of extremely low interest rates, stocks earned a whopping 16% annualized return. But if we go back before then, on the left side, when the money supply was tighter, stocks earned just under 5% per year. And now, more recently, on the right side, where we return to normal monetary policy, stock returns have averaged only 6.2%. So we think that until inflation is fully under control, stock returns should probably be lower than they were during the easy money period. We also think that the tighter monetary policy isn't just affecting financial markets, it's also threatening our government's sustainability through higher borrowing costs. Here we can see the federal government's 2023 inflows, such as tax receipts in green, and outflows, such as spending in blue. And the first thing we see is that there hasn't been enough tax revenue to fund all of the spending, which has led to a growing deficit, or borrowing. In fact, there's been so much borrowing that the Federal Reserve Chair Jerome Powell recently warned that the U.S. federal government is on an unsustainable fiscal path, where our federal debt is now growing faster than the economy. To make the problem worse, higher interest rates are making it extremely expensive for the government to carry all this debt. It's reached the point where 30% of individual income tax receipts went to pay for interest on government debt last year. The Fed knows this problem could be made better by cutting interest rates, but the Fed's main job is to fight inflation, so they're not going to be making any big rate cuts right now. Fortunately, there are a lot of other ideas on the table, such as raising taxes, cutting spending, increasing borrowing, stimulating the economy, controlling the yield curve, or monetizing the debt. And each of these ideas has pros and cons for investors. For example, higher corporate taxes could hurt stock returns. Spending cuts could help bonds, but hurt stocks, at least in the short term. And debt monetization, or printing money, can push stock prices higher, but at the risk of hyperinflation. So, what can we realistically expect when it comes to future investment returns? Well, this graphic shows that investment firms generally agree on several things regarding future returns. First, there's a consensus that U.S. stock returns will probably be much lower in the next decade than they were in the past. In fact, most firms are expecting U.S. stocks to earn only between 4 and 7% a year. That's a lot lower than the 11% that U.S. stocks delivered over the past decade. The second area of consensus is that international and emerging market stocks are expected to gain traction and beat U.S. stocks by several percent a year. Finally, most firms are expecting U.S. bonds to earn between 4 and 6%, which is not only a lot more than what they earned in the past decade, but it's almost on par with what U.S. stocks are expected to earn over the same time period. So the message here is to be prepared for a likely major rotation in market leadership over the next 10 years. And to see how these long-term views fit in with our shorter-term tactical views, I'll hand it back to Ryland.
Thank you, David. Despite the inflation and interest rate risks, we continue to see some long-term value across all the asset classes. However, we do have some shorter-term or tactical views. In the past month, in the fixed income space, we've begun to favor cash and low duration a little more relative to the longer duration bonds due to our view that inflation could prove to be more stubborn than the market may be anticipating. For stocks, our broad overall asset class view remains neutral, but we see U.S. large cap as being relatively fully valued, while small cap, international, and emerging markets remain relatively attractive. And we continue to like hedge strategies as a diversifier. We'll continue to monitor the market and keep you all updated. Your advisor will work closely with you as specific opportunities become available. April 22nd is Earth Day, and Arnerich Massena is heading out in the spirit of Earth Day to help clean up downtown Portland on April 19th. This is the second annual We Believe in Portland event hosted by Thesis, PGE, and Adopt One Block, in which a group of Portland leaders and companies will gather downtown to clean up the city and support local businesses. We were there last year and are excited to participate again. If you'd like to join the effort, please visit www.webelieveinportland.com to learn more. Thank you for joining us today.